Joining us now on the news line is Jefferies analyst Sheila Kahyaoglu. Sheila, twice in 1 week here. Want to get your reaction to this pre-announcement we do get from Boeing, including $5 billion in charges being announced.
Thank you so much, Morgan. Yeah, I think we touched on it a little bit maybe in our conversation earlier in the week, but I think what we've been telling investors is in Boeing's best interest to kitchen sink as much as possible into 2024, with obviously defense being a watch item, S&P putting Boeing on credit watch negative, the other two agencies there already. They want to see free cash flow positive in 2025. So Boeing is doing everything in their power to put everything into Q3 that they foreseeably can without even being able to fully assess the strike, given that's continuing.
The defense piece of the business, we know that their defense CEO parted ways with the company a couple of weeks ago. What does it take to right that ship? And I guess perhaps just as importantly, as it looks to recover or clean up that business, does that business longer term make sense alongside the commercial one?
Yeah, we've struggled with this. I think that's probably what Brian West, the CFO of Boeing, is struggling with as well. There are a lot of good parts of Boeing defense, but there's also 5 programs that are currently loss-making. It's a $2 billion drain, on round numbers this year, $1 billion next year. Let's hope it breaks even in 26. The company's a little bit more optimistic on that. Those are the problem programs, and how do you truly get rid of that? Who's going to buy a program losing $1 billion next year? So I think that's the struggle, but there's other good parts of that business. This used to be a 10% EBIT margin business with about $3 billion of free cash flow associated with it. So it's about how do you actually monetize those assets? Who's willing to take them on for the longer term gains? It has to be a strategic, clearly, or some sort of partnership. So I think that's the struggle, but can you perhaps sell off other bits of the business that are doing fairly well, and how could you monetize that? And obviously services comes to mind first. This is a business that's doing really well. It's commercial aftermarket 50%, defense aftermarket is the other 50%, 20% op margins, $3.5 billion of free cash flow essentially. So it's paying the bills right now for the commercial and defense businesses, but clearly you can't sell that given what a free cash flow generator it is. So Boeing does have assets within it that are potentially strategic to others. It's just a matter of how can you best monetize them?
I always love speaking with you, Sheila, because you just throw the numbers out there. So all of this happening with a machinist strike also happening. So I just wonder how much of that is factoring into these pre-announced results we're getting here today, how much uncertainty that injects, and perhaps just as significantly, if Boeing is in this position where it's trying to staunch the cash bleed, how much those machinists, those workers can actually realize here for their contract as the company is letting other workers go in the meantime.
Yeah, thanks so much, Morgan. I think I'm always about the numbers, but I'm also finding a silver lining. And if there is one silver lining in this pre-report, it's that $1.3 billion of OCF used for the quarter for Q3. We had estimated 3.5 or so, or closer to 4. So that puts the cash balance, if I'm not wrong, at $10.5 billion. Folks are anticipating some sort of equity raise, thinking the cash balance is closer to 8 to 9. So that $1.3 billion of cash used in the quarter definitely is a positive, just to keep that in mind in terms of what they have to do imminently, given we have no idea when the strike will end. So hopefully that puts some perspective on what to do next.